Hey, this is Sasha. Thanks for joining me in this week's video. What I want to share with you today is how to set up an options diagonal trade, kind of a strategy here, even when the VIX is high. So if you have been trading diagonals for a while, you understand that they're typically positive vega trades. And normally you get hurt when the VIX is a little high because the VIX will eventually revert back to its mean. So stay tuned. I'm going to answer this question for you with some examples. All right, so one of the reasons that we're doing this is we're covering the diagonal strategy today is because we have an upcoming course for the Options Mastery Trading Diagonals course series. Now you can go ahead and check this course out by going to our website at tradersfly.com. Once you're there, just scroll a little bit down and you can see the links there by just clicking the Learn More button. It'll take you right to the course. So if you want to get the course, you could get it at a discount. This is typically when we do discounts, promotions, and all that good stuff. And you can get about 30% off by using the coupon here, coupon code right here on screen. Now, this course is packed with over 11 hours of material at the moment, and we continue to expand on it for the meantime. And you can learn a lot of different things like how to build a portfolio using diagonals, how it's constructed, the different types of Greeks, delta, gamma, theta, vega, how they work together, how to set up a neutral diagonal, why diagonals are great when even if you expect a pullback, and the advantage, the volatility advantage to trading diagonals. We're going to look at setting up a neutral diagonal, double diagonals versus iron condors, and much more. Hybrid diagonals, we'll look at starting position when the VIX is low, starting position when the VIX is high. And this is really what we're covering here in this week's video. So we're going to be looking at starting a diagonal position when the VIX is high, which we currently have right now. And we'll show you kind of some basic insights. Of course, in the course material, we go in much more detail than what I'll do in this video, but this will give you a little bit of a taste of what this course is all about. So in either case, if you're interested in this, go ahead, go to the tradersfly.com website, and from there you can get linked up directly to the page to check out our Diagonals Spreads course. All right, with that being said, let's take a look at how to set up this trade idea when the VIX is high. So one of the problems with doing diagonals when the VIX is high is you get hurt on volatility. And right now what we've had is an extreme case of major volatility. I think it's some of the highest that I have on record over the last 3 years here. So we've been hitting volatility of 85. And that's pretty high. Normally we typically range between about 25 to about 10. And if you don't know what volatility is, it's just basically the magnitude or the range that stocks are moving in any given day. So normally you might have up 10 points, up 7 points, up 28 points, and then down 15 points, down 12 points, down 22 points. And I'm referring to the S&P 500. These days, what you might have in higher volatility environments, up 180 points, up 210 points, down 230 points. So the magnitude is much more serious. Now, when you have positive vega trades, like a diagonal or like a calendar, you get actually hurt when volatility contracts. And with a high volatility, more than likely, volatility will come down. So how do you set up a trade on a diagonal when the volatility is high and still not get burned too much? Well, let's first take a look and understand how options really are priced or where you make money. So we make money from price, we make money from time, and we make money from our volatility. This is where our money comes in. Now, if you look at the Greeks, this is our delta and gamma, time is our theta, and volatility is our vega. So if we may lose money on the vega, which is concerned with diagonals, you have to be able to make it up on the theta or the delta. So that's just the name of the game. You have to balance things out. If you're not making money selling bananas and you own a fruit stand, you got to be able to make money selling oranges and apples. So you need to be able to compensate for it somewhere else. And that's what we're going to try to do, is either make money from the theta or the delta and the gamma. And I'm going to show you how this works. And you can also manipulate a little bit of the vega. So let's take, for example, Boeing right here. And we'll do the stock BA ticker symbol. And we'll look at the let's go here to the most recent chart and we'll go to the daily. You can see the stock has sold off quite a bit. So we've been moving kind of sideways and then we've sold off. We were at about $350 a share. Now we're down at about 100. We bounced, we're up at about 180 now. So you can see the magnitude of moves are quite significant. So at 350, down to 100, now at 180. So how do I get into this position or think about it as a diagonal And we've got high volatility, because normally what happens is if I go ahead and look for this position on a bullish context, because, well, the market's dropped quite a bit, right? I'm looking to invest in the long run. So if it's dropped quite a bit, let's say I go ahead and buy a diagonal, and here what I'm doing is I'm selling 50 days out, and I'll buy the 85 days for protection. So I'm selling the Mays, buying the Junes, selling the 50 days because they expire and decay quicker, buying the 85s because they expire a lot slower than the ones I'm selling. And that's how you make money. So if I go ahead and structure this from a calendar, okay, May and June, you can see right here, this is balanced. But the problem here is we've got so much movement whipping around, I need to be able to make money somewhere else. So let's bump it up to about 10 contracts for now, just so that way we can see the difference in the numbers. You can see my Vega or volatility here is 74, positive Vega. And if I manipulate the volatility theoretically in time, if volatility goes up, let's say 3 points, well, you can see my profit and loss goes up $222, right? 74 times 3, you're looking at about $220 based on these figures. Now, if volatility goes down, because remember, we're on the higher range right now, so let's manipulate this and go to a -3. Well, you're going to be down $220. Let's say we go down, 15 percentage points. Well, now you're down 1,137. So you can see if you're trying to start this position at a higher volatility level and you've got a positive Vega trade, it can hurt you. So you need to be able to compensate it through the delta or the theta. And how do we do that? Well, number one, remember, when do you have higher volatility? It's when stocks sell off. So typically what happens when volatility goes down? Well, stocks go up because they're just going up nice and slow, right? They go up much slower than they come down. So in order to do this, what we need is to rotate our calendar and convert it into a diagonal. And the way that we do that is we take these strike prices and we start rotating them. So I'll just show you that if I go ahead and change one of the 185s, the one that we're protecting, to a 180, you can see I've went ahead and transformed my delta to about 32. What does that mean? That means for every $1 point the stock goes up, I make $32. If it goes down $1, I lose $32 because I have a positive delta. Now I could rotate this further. Let's say I change the strike to 175. Well, now my rotation continues to accelerate or ramp up, which means I have a faster delta, 53. So what does that mean? When volatility goes down, right, stocks will go up. And in our case, we have positive Vega trades. So the 53 delta will be making money on the 53 delta, but we'll be losing money on the Vega side, right? You're selling your apples, you're losing money on bananas. So in this case, what we're doing is we're creating a little extra rotation. And this is really the way that you could set up a trade in low volatility or high volatility environments where, hey, you might have a problem with the volatility, but you need to be able to make it back based on maybe the delta in this case. Now, can you go ahead and reduce and compress your Vega as well? Yeah, absolutely, because now what we're doing is you can see our theta can really make up a lot of the Vega problem that we may get. We have a 119 theta versus a 30 Vega, and we got 103 delta versus our 30 Vega. But let's back this up a little bit, and just to show you, illustrate the example of how you might do something even more creative. So here in this trade and strategy, we have a 106 theta versus a 72 Vega. So you can see in one day, we can go ahead and make up that difference in volatility. But if I go ahead and let's say convert this to a shorter duration trade, let's say I buy protection in May and I go to April for the ones we're selling. Ultimately, what I'm doing here is I'm going from this 50 and 85 day trade, right? Here's the marriage that we have, the 50 day and 85, May and June. I'm going to the April 17th. Let's say we go to April 17th and we can go ahead and go to May 1st. We can shorten up that little duration, number one, by going over here, and shorten up the duration in between the strikes as well. So that's another thing that we can do. So let me just show you what that looks like. So here we have the ones I said was April, let's say April 17th, and let's go May 8th. April 17th and May 8th. April 17th and May 8th. There we go. So you can see we've got about a three times the size theta in this case. We've got a vega of 63, theta of 183. So maybe not quite 3, but around there. So we do have theta that works really well for us in this case. Now what I can do is I still have that positive vega. How can I convert that to more of a negative vega? Well, what I can do is go ahead and number one, or get more theta, shorten this duration. Go from May 8th to let's say May 1st. So look at that. Now my vega is only 44. My theta also, went down a little bit, 140, but I've reduced my vega exposure. Let's go a little further. Let's say April 24th. Now I'm at a 23 vega. And what does that look like? Okay, still a calendar, right? But I'm reducing my vega exposure. And if I go to the same one, well, it's even because I'm buying and selling the same one. So I can only go one difference in terms of calendar or time frame if you're doing this kind of spread. Then what you do is you'll start rotating this. So you'll rotate and look, I've reduced my vega even more and reduced my vega even more to the point where you can even convert it into a negative vega trade. So look at this diagonal. I actually now have a negative vega setup on typically a positive vega trade. And that's ultimately the way that you could set up a trade that's positive vega or a diagonal trade, convert it to number one, make money from the price, like the delta, or the theta to make up the difference where you could actually be hurt on the vega. Because these trades, you get hurt on the volatility side, and especially with volatility being so high, if you go ahead and volatility is reduced, then what's going to happen is you'll get hurt on the volatility, but at least you'll make it up on the time premium or the price when prices move up. And if you go ahead and compress the time from the strikes, such as less time in between them, you can convert it to even a negative vega. Be careful doing this because now you've structured price for prices to go up, theta and time is going to work for you, but also volatility. So it all now needs to go up. So just be careful because you might be overdoing it and overcompensating it. So if you're brand new to this, make sure you tweak it slightly a little bit at a time. But I just wanted to open up your eyes and mind to see that, hey, how can I go ahead and tweak these strategies still in positive, high volatility environments? Anyways, we cover this in much more detail in our course, so definitely check that out at our website, tradersfly.com. Once you're there, just scroll a little bit down and go to learn more on the diagonals course. Or you could also check out all the products we have on our product section. Go to courses. There's a ton of different courses. Even if you're brand new to trading options or stocks, we have some more beginner courses as well. Can you go ahead and get the diagonals course if you have just some basic knowledge of options? Absolutely, but I would say also take a look at maybe one of the other option courses that we have in the series because it'll give you a better foundation. Anyways, for the time being, we do have that coupon code, so check it out. And there's a ton of modules here that we're covering and trade setups that we'll get into, along with a webinar in the future. Check it out at tradersfly.com. Don't forget to also sign up to our newsletter list by clicking the link right over here, or subscribe on YouTube by clicking the face icon here as well. And I'll also put the links in the description below. Thanks again for joining me, and I will see you next time.